In this section, we're going to talk about RMDs, Required Minimum Distributions. Almost all of your clients are going to need to withdraw required minimum distributions from their IRAs. Required minimum distributions is the amount of money that the IRS requires an individual to withdraw from their traditional IRAs starting at the time they reach age 70 and a half. Traditional IRAs represent pre-tax money. Sometimes they accumulate in 401ks and 403bs. Those are all types of pre-tax money buckets. The IRS basically says, okay, you're 70 and a half, you've tax sheltered this money long enough, you need to start withdrawing some money. In fact, we're going to force you to start withdrawing some money. And really the only reason they make you withdraw the money is so they can tax you on that income that you realize from the withdrawal. Required minimum distributions can be a huge leverage point when it comes to selling people on your financial planning services. Required minimum distributions, if not planned for and invested for accordingly, can significantly erode an IRA over time. If someone's forcing you to withdraw money, ideally you want to be able to earn at least that amount of money to keep your IRA balance intact. So in a nutshell, here's how this works. When you're 70 and a half years old, as of right now, and this changes every year, the IRS says your life expectancy is 27.4 years. Calculating RMDs is actually quite simple. All you do is you take the December 31st value of the year in which you turn 70 and a half, and that's your required, that's the amount used to calculate your required minimum distribution. So let's say, for example, someone has $100,000. All you do is you take the value divided by the life expectancy, and that's what the IRS forces you to withdraw. That's your required minimum distribution. This number is found on the IRS's life expectancy table that they publish every year. In this example, $100,000 divided by 27.4 equals $3,649. That's the RMD. Now fast forward to an 80-year-old. When you're 80, your life expectancy is shorter. Therefore, your life expectancy factor from the IRS is going to be a lower number. When you're 80 years old, the IRS says your life expectancy is 18.7 years. Naturally, as you divide by a smaller number, it's going to yield a bigger result. $100,000 divided by 18.7 is $5,347. Let's jump all the way ahead to age 90. At age 90, the IRS says your life expectancy is 11.4 years. Again, doing the same math, the account balance divided by the life expectancy is 8,771. Now, I structured things this way to illustrate a very important point. And this is often very similar to how I will structure my RMD presentation when in front of a client. I use $100,000 because it makes these amounts very easy to understand, because it's easy to relate to percentages. For example, this is easily seen as 3.65% of the account value. This is, of course, 5.35%, and this is 8.77%. So naturally, as someone gets older, their life expectancy gets shorter, and whenever you divide by a smaller number, it yields a bigger percentage that needs to be withdrawn. Every year in between, an RMD is going to be taken, so every year the amount they need to withdraw as a percentage to their account value gets bigger and bigger. The challenge in planning for required minimum distributions is, in general, as someone gets older, they're going to tend to be more conservative with their money. However, as someone gets older, they need to earn more and more on their money just to break even with what the required minimum distribution is going to force them to withdraw. So it's very difficult to get more conservative and earn more money while getting more conservative. And that's the conundrum that you're helping your clients plan around. Now, with that said, there's no rule that just because they withdraw the money, they need to spend it. They can, of course, save the money to preserve the money, but they at least have to pay taxes on the money. Your whole goal as a financial advisor is, when dealing with IRAs, is, in a perfect world, the balance of their IRA, the tax shelter, stays intact to be as big as possible, even while taking out the RMDs. The ability for a child or a grandchild to inherit an IRA and parlay that tax-deferred growth for a while over their lifetime via a stretch IRA, which is a whole other topic, is very powerful. So the ability to preserve the balance even while RMDs are being taken out is a very valuable thing to offer to a client. You'll learn in future videos how we structure IRA money through growth and income buckets to accomplish the challenge of earning a higher rate as RMDs are forced to be taken out. This presentation is also very valuable when you run into that 65-year-old, for example, who has a lot of money very conservatively invested. Maybe it's not even invested at all. Maybe it's just in CDs or some sort of stable value fund in their 401k. And let's say that that CD is earning 1%, 1.0%. That's even high for a CD these days here in 2014. If you're watching this video 5 years from now, hopefully interest rates are a little bit higher for CDs. But at any rate, if someone's earning 1% and they're going to be forced to withdraw over 3.5% down the road just for RMDs, they see very quickly that they can't stay that course and maintain their IRA balance. The RMDs are going to be more than what they're even going to be earning. So this certainly builds the case to be invested productively so you can at least earn that much of a return on your nest egg. This concept is very, very important. You're going to be dealing with it all the time with your retirees because most of them will have IRA money and most of them will become age 70 and a half. So you're going to deal with this concept. Being able to explain the concept clearly and show the challenges about dealing with the concept is very valuable to your clients. Clients will hire you to help them solve this. This is one of those problems that people don't even know exist until you lay it out for them and show them that it's a problem. It's going to erode your IRA over time if you don't plan for it accordingly. Study this concept, understand how to calculate the RMDs, understand how to lay this out on the board so clients can clearly see that the percentage that needs to be withdrawn increases over time and it needs to be planned for.